Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just wrapped up one of kind of a surprising podcast, I would say, to say the least. Is we just had Robert Murphy on here, and American Economist with some amazing credentials, which I'll touch on in a minute. But Anthony, what were a takeaway or two that you had from this podcast?
Well, I tell you, I was really looking forward to this because I would say I just heard him speak last month. And he was the first one. Here's what I've always heard. People would say, well, like, I think we all know, I don't think anybody is arguing that we're due for a recession.
Right.
But you ask anybody, it's a year or two from now. Right. And it's a year or two. It's like,
or it's coming. It's way off. Right?
Yeah. It's way. He gave like, he was very specific that it is coming. And you have to listen to the podcast for the date. But what was interesting, I didn't even know this, and we're going to put this link in the show notes, but he predicted the Great Recession. And what's the date? October?
Yeah, October 2017, he said, prepare for the worst recession in 25 years.
Well, October 2007.
You're correct.
Right?
Can't read my writing.
Yeah. So before the last recession, there's a video that we're putting in the show notes that he goes, hey, guys, there's going to be a recession, and he was right. And right now, you know what he's saying? Hey, guys, there's going to be a recession. Cameron, what were some of your highlights from today's?
Yeah, some highlights that I had was when we kind of started talking about bringing an economist on our podcast. And, you know, one of the questions that we're asking is what kind of value does that provide? And what I hope that our listeners understand is that there are alternate schools of thought that are out there. And what I hope that you get from this conversation is that you get an introduction to Austrian economics. And essentially what Austrian economics is, it takes an alternate point of view, and it provides an explanation of what our economy has been doing throughout history of kind of this boom and bust cycle, right? And what you see is a lot of people that are often caught off guard by these busts. And so if you have an understanding of Austrian economics, in my opinion, you will be more prepared for some of these things that are happening in the economy and on Wall Street and those things. So I hope that somebody feels confident, does some research after this, and walks away with some added value here.
Right. And that's partly why our next episode is going to be, well, if you know or believe there's a recession happening soon, what can you do now? Yeah. I kind of say it's like if we could go back in time to the summer of 2007 and you knew a recession was about to occur, what things would you do differently? And the way that I see it right now, that's kind of where we're at. There is a recession looming. What can you do now to be in a better position, right? Because a lot of times people think a recession is bad news, but one of my mentors, Van Miller, always talk about there's just news. It's not good or bad. Like when there's a recession, there's going to be some opportunities there.
Yeah.
So it's important to know what's happening. Like you actually always say this when quoting Nelson, and I'm paraphrasing. If you know what's going on, you will know what to do. Mm-hmm. I think right now there's too many people that have no idea what's going on. They don't know what to do, and we want to change that.
Absolutely. And that's one of the reasons we brought on a credible, amazing, insightful economist. I'll read some of his credentials here. As we had Bob Murphy. He's got a PhD in economics from NYU. He's a senior fellow with the Mises Institute, sits on the board of the Nelson Nash Institute. He's testified before Congress, has had numerous interviews on TV and radio, and he's the author of hundreds of articles and several books on economics. So I hope you guys enjoy this podcast, and take care. Bob, we'll get started. Let's jump right in there. How does one become an economist, or how did you get started down this road?
Or maybe even why? I think I want to add the why question there.
Sure.
Well, I was originally, when I was in like junior high, I was really interested in physics, and that's what I thought I was going to do. And then my dad was listening to Rush Limbaugh, and I just started hearing what people would call conservative political commentary, and then I started reading newspaper op-eds, and I came to follow the ones that had called themselves conservatives. But then I realized after a while that I wasn't really conservative. It was more like the libertarian free market economists were the ones that I was really interested in. And just, the case for free trade and why the minimum wage actually doesn't help poor people. Just reading stuff like that. I got really interested in the self-regulating nature of markets. And I started reading Henry Hazlitt, Murray Rothbard, Milton Friedman. But then that took me more towards what's called the Austrian school. And like I say, Rothbard and Ludwig von Mises were the ones that really stood out to me. And so I decided in high school at some point, by the time I had reached senior year, I knew I wanted to become an economist.
Wait, so you were reading all those papers in high school?
I mean, yeah. I read like Human Action, which is Mises' major work, as a senior in high school. So I didn't understand all of it. But yeah, I was reading that stuff in high school.
So you're reading like real educational stuff while Cameron's still like reading comic books. Right? I got you.
Well, it wasn't a very fun high school experience, if that matters.
So you had mentioned the Austrian School of Economics. Would you mind explaining what it is that means and how that's different from other schools?
Sure. So just for your listeners, a school of thought in economics is just sort of like they have common organizing principles and ways of talking about economic matters. So there's like the Chicago School, which is associated with Milton Friedman, that people probably know about. And there's also the Keynesian School associated with John Maynard Keynes. So like the Keynesians are the chief foil of the Austrians. The Keynesians believe in demand management, right? So if there's a recession, it's because people aren't spending enough. And that's why the Keynesians think the proper thing is for the central bank to cut interest rates or for the government to run a budget deficit because we've got to boost spending. So the Austrian school, it's named after the fact that its founders happen to be from Austria. That's where the term came from. But so it is true that they have a very free market outlook typically, but it is a scientific school of thought, right? That they have specific theories about how the economy works. And it's just, if you understand the working of the economy from an Austrian perspective, if you have a normal value system, you're going to end up, favoring laissez-faire in most cases. So what sets the Austrian school apart, especially in a financial context, is they have a particular theory of the business cycle, which says that the commercial banking system, aided and abetted by the central bank in modern times, floods the market, the financial system, with artificial credit or cheap credit, let's say, and that pushes down interest rates. And so again, like in the Keynesian analysis, that's a good thing. The central bank is helping if the economy is depressed by pushing down interest rates. In the Austrian school, though, that's what gives us the boom-bust cycle. So it's not that recessions are just some natural outgrowth of capitalism, the way some people think. The Austrians say, no, it's this systematic interference with interest rates by the banking system that causes an unsustainable boom. And so that's something that Ludwig von Mises developed, and then Friedrich Hayek elaborated on. Hayek won the Nobel Prize for that in 1974. So in any event, the Austrians do a bunch of other things too. They have a theory of where money comes from and so on. But in terms of why is the Austrian school so relevant today, I think it's because they have the best explanation of what causes the business cycle. And in particular, because if the Austrians are right, that means what all the major economies are doing right now is the wrong thing, right? Since the financial crisis, all the major central banks, flooded their systems with tons of free credit, pushing interest rates down to rock bottom levels. And in the Austrian analysis, that's the wrong thing to do. That interest rates are a price, a signal, and if you're sending out the wrong signal, that's not good.
Okay, great. So how does the government technically do that? Where we're getting to with quantitative easing, is that one way that the Keynesians do that?
Yeah. So, mechanically, so even before the financial crisis, even before quantitative easing, central banks would sort of influence, especially short-term interest rates, and they would do that by buying and selling assets. So real quick, if the government wants to push interest rates lower than they are right now, they can start buying assets. And then by doing so, the way modern central banking, especially with a fiat currency, like since all the major powers went off gold, right now, like if the Fed buys $1 billion worth of bonds, just think of it as the Fed is literally just writing checks drawn on the Fed, to people in the private sector, bond dealers. When they go and deposit those checks with their own commercial banks, the banks now have more reserves with the Fed. Like this, it's just a bookkeeping operation. And so there's a very real sense in which the Fed's action there just created $1 billion new dollars, the way our, the legal structure works right now. And so by pumping in more money into the markets where the reserves can be lent, that pushes down interest rates. Just the supply of savings goes up, the rate of interest goes down. So that's the mechanism. So with QE, it was the same idea. It just once short-term interest rates had hit 0%, for the Fed to announce what it was doing to, quote, help, it couldn't say we're cutting interest rates more because they'd already cut them down to 0. So then they started telling everybody, look at all the assets we're buying. And they kind of switched to, telling them the total volume of assets they were going to add to their balance sheet. And so that's kind of what signified, that's kind of the difference between QE and previous. But the same mechanism is basically the same, the mechanisms are basically the same, of the central bank creating new money and thereby trying to push down interest rates. And again, the goal being just to stimulate spending. So in the Austrian view, when you understand like what's the problem when there's a recession, what does that mean? It's not in the Austrian diagnosis, no, people just aren't spending enough. It's that resources were misallocated during the boom period. Like in the recent, in the housing bubble years, there were too many resources going into housing, for example. And so the whole thing was unsustainable. You don't fix that just by creating $1 trillion of electronic money and giving them to politically connected groups. That's not how you fix that problem. So that's kind of in other schools of thought, their models of the economy are so crude that, they're real simplistic models. And so if it is just a matter of, two curves crossing and where does aggregate supply grow, aggregate demand, and it's real easy for the Fed to solve the problem just by dumping in $1 trillion. But in the Austrian view, it's because if you want to use the word model, I think is more realistic. They have a interlocking capital structure. Things can get screwed up when the interest rate has been wrong for several years. And so then there's a day of reckoning, and it takes time to flush those mal investments out of the system in the Austrian view. And that's like the actual benign function of a recession. So in the Austrian view, it's the boom period is where the problems are occurring, where entrepreneurs are starting long-term projects. There's not enough savings to complete. And the recession's actually like when cold water gets slapped in your face and you snap out of it and you scale back your goals to be more reasonable. So it's painful, but the idea. Another analogy people use is like if you have a bender drinking and then you wake up with a hangover. And yeah, you could just start drinking more, but then that's just going to prolong the problem. So that's another common analogy with this stuff, that if it was artificially low interest rates that caused the housing boom, for example, then the crisis hits. And if the cure is, let's push interest rates down to 0 for 7 years and dump in even more money, well, that's just building up another problem that's going to be even worse than what the 2008 crisis was.
So anticipating kind of low interest rate environments, do you see a scenario in which we'll have negative interest rates in the U.S.?
I wouldn't rule it out. Let me be honest. I'm surprised that it's happened in, Japan and parts of Europe. So the fact that I'm saying I doubt they would come to the U.S., I also would have doubted they'd go to the other places too. So I should just be honest there. So maybe I'll be surprised again. But no, I don't think it's going to happen here. On the other hand, it is, I guess we'll have to see just how aggressive they're going to be. It ultimately comes down to, I think they're going to keep having these crises pop up, and they're going to have to decide, are we going to just keep, doing more of the same, but amping it up, or are we going to eventually just throw in the towel and let the crisis hit and get it over with? So my prediction would be they're not going to do negative interest rates, but again, that's more of a that's not like something that falls out of economic law. It's just that's my gut that they're not going to go that path, but I guess we'll see.
And there has been a lot of talk of the negative interest rates, and again, maybe I'm hoping our politicians will take some logic, which is a far leap, but how long has Japan had negative interest rates, and has it helped them?
Yeah, off the top of my head, I mean, I think it developed sometime after the crisis struck. So I'm not,
Little under 10 years, or
yeah, something like that. I think. And again, when you say has it helped them, I mean, it's certainly not that their economy's doing great. And that's kind of the irony with when the Fed was going to start all the rounds of QE, and many of us, myself included, were concerned about, gee, that might really hurt the value of the dollar and cause significant CPI inflation going forward. And a lot of people were poo-pooing that and saying, no, look at Japan did massive rounds of QE like in the late 90s, and their economy's, they've been in the toilet for 10 years. Why can't we do the same? In other words, like they were saying there wasn't an inflationary blow up over there. They've just been stagnant, so it's never that this stuff actually works. It's just, some of the particular warnings that some critics give, they could say, well, no, that thing didn't happen. And it's still, so likewise here, yeah, it's hard to know ultimately what the counterfactual is, right? So the defenders of negative interest rates in Japan would say, look at how bad our economy is. If we hadn't done this, I mean, we'd be even worse. And it's so, whereas we could just point to it and say, yeah, this doesn't look like it did a very good thing, did it? So that's kind of the trade-off you have, that with all this stuff, ultimately the defenders of the policies are going to say, well, compared to what it could have been, this stuff was, it shows there was medicine. Whereas I would say, well, no, it's poison, and look at the results.
No, Bob, I saw you speak at the last two think tanks in particular. And honestly, Bob, I always enjoy your speeches. You're very knowledgeable, and you add a little humor and make it easy to understand.
I appreciate that.
Well, and just for our listeners to know that what actually, Bob, you want to explain what the think tank is? You could probably do a better explanation than I.
Sure. So it's you're referring to the IBC think tank put on by the Nelson Nash Institute. So it's just an annual event. So the think tank in this context is an event, actually, as opposed to an organization. And so it refers to, the annual meeting of the Nelson Nash Institute for the financial professionals associated with it. So it's sort of like a closed door session. People can invite a guest if they want, but it's sort of like a coming together of all the financial professionals who believe in the infinite banking concept as Nelson Nash developed it. And that's the annual trade meeting, if you will, where, put on presentations and I give up an economic update, stuff like that.
When the think tank for 2019, you did a very good job explaining the inverted interest rate curve. And that I've heard people talking about it, but the way you were able to do it made a lot more sense. You also had some slides there, which makes it a little bit easier. But could you maybe explain verbally what this inverted curve is and what it means?
Sure. So it's the inverted yield curve is the label or the concept. And so it actually happened a few times depending on which portion you look at earlier in 2019, but it really hit in August of 2019. People might remember that, markets fell and people were really worried about the yield curve. So what the yield curve is, it's just showing as you go out on so if you had on the x-axis, you're picturing a graph. On the x-axis, as you're moving out to the right, that's bigger, longer and longer yields, right? So like a 3-month, 6-month, 1 year, all the 10-year, 20-year, 30-year, and then the y-axis as you go up is the interest rate, the yield on that particular maturity of that bond. So a so-called normal yield curve is upward sloping, meaning that like if you're talking about treasuries, that the yield on a 1-year treasury is higher than the yield on a 6-month. And the yield on a 10-year is higher than on a 1. The yield on a 30 is the highest of all. And the intuition is if you're going to tie your money up longer, you're going to want to get a higher annual rate of return. That's kind of the idea, right? So that's what a so-called normal yield curve is. And then an inverted yield curve means when the shorter maturities have a higher yield than the longer ones. And so the yield curve, instead of being upward sloping, is downward sloping. So for whatever reason, I can talk about that in a minute, for whatever reason, since World War II, every time the yield curve has inverted on U.S. Treasuries, there has been within a year to 18 months, there's been a recession. And it's also the other way too, that any recession that's happened since World War II, there's been a preceding yield curve inversion. With all this stuff, like you have to define it properly, and so. But that's what I'm saying is the spirit of it is correct. So it looks like this thing is a great indicator of a coming recession. And so then the question is, well, why? And so at the think tank, what I was doing is showing that, yeah, that thing inverted last August. If the patterns hold up, that means a recession should be hitting the United States sometime like by this summer of 2020. And then I was just tying that to the Austrian story that I told you guys a minute ago, that it actually fits in quite nice. So we have this, this correlation, this historical pattern, and then economists argue about why should this pattern exist. But I think it lines up well with the Austrian theory. That, remember, in the Austrian story, the banking system floods the financial sector with new credit that's artificial, not backed up by real savings, that pushes down interest rates. But if you think about it, it actually pushes down short rates more than long rates, because the central bank has the ability to control short rates but more. So if it's pushing down short rates, you'd have an upward sloping yield curve. And then when they slam the brakes, it's primarily short rates that rise. And so, and I showed it, you saw the presentations, Anthony, at the graphs I'm showing, when the yield curve historically inverted, it wasn't, what we know to say it inverted means that short rates are higher than long rates, but in principle, it could be because long rates came down, but that's typically not what happens. Typically, when the yield curve inverts, it's because the short rate shoots up above the long rate. So I'm saying that lines up with the Austrian story as to when the banking system slams on the brakes. And so it's not surprising if you had a period of artificially low rates, then followed by jacking up short rates, that a crash happens and then a recession begins, right? So I'm saying that pattern of an inverted yield curve going hand in hand with a subsequent recession lines up pretty nicely with the standard Austrian story of what causes recessions. And so that, that's just my long way of saying that I think this indicator makes sense. And in any event, whether the Austrian theory explains it or not, so to be clear, the inverted yield curve being a signal of a recession, that's not a uniquely Austrian thing. That's just everybody who follows financial news knows that. And so I'm saying whether it's the Austrian theory or something else, but that indicator was flashing a warning light as of last August. And so far, we're still totally within the realm of, it still hitting the pattern. In other words, some people months after that happened were saying, oh, I thought we were supposed to get a recession. But it's like, if you look at the timing from all the previous inversions, like it wouldn't have been obvious yet they were in a recession. Like there's still a lot more time before it to fully hit. So it might, this might be the first counterexample since World War II. Obviously, things are kind of crazy now in terms of interest rates. So maybe this time is different. But I'm saying so far, even if the yield curve has the same pattern as before, it wouldn't yet be obvious.
What are some other factors that you feel might be playing into a potential recession?
So, I mean, all this, okay, let me put it this way. I thought that what the Fed had done in the mid 2000s had set us up, the U.S. economy up for a crash. And I did some of this in real time. Like, for example, if people want to Google Lara-Murphy, the worst recession in 25 years, there's a Mises.org, so MISES.org article that I had come out in October of 2007, right? So that's 11 months before the financial crisis, when I was using this standard Austrian theory that I just was, describing to you guys to show that, wow, the interest rates, and I quantified it, show charts, had been pushed down during from like June of 03 to June of 04, the federal funds rate was at 1%. And so when you take into account price inflation and see what the real federal funds rate was, that was the lowest it had been going back to the late 70s. And so I was saying, if the Austrian story is right, and artificially low interest rates spawn malinvestments, and that has something to do with the severity of the ensuing bust. So as of 2007, I'm telling my readers, get in store for what might be the worst recession since the bad recessions that hit in the early 80s, because at the time that was the worst since the Great Depression. So that framework, led me a year ahead of time to be worried that not only that we we're going to have a recession, but that it was going to be the worst one since the early 80s, right? So that's whereas a lot of other people, including Ben Bernanke, kept, assuring the public, no, everything's fine. There's some froth in the subprime, So that kind of gave me confidence that the Austrian model or explanation is solid. And I'm saying, so if you use that same framework, I was pointing out how holding interest rates at 1% for a year could explain the housing bubble and why we're going to be in store for a bad recession. Okay, so now what happened since 2008? They held interest rates at 0% for 7 years. And if you look at a different metric, like, okay, well, how much money did the Fed pump in? The Fed quadrupled what's called the monetary base, or if you think of it, the Fed's balance sheet, they basically quadrupled in the course of a few years. And they doubled it in the first 3 months from when the crisis hit. So if you would all subscribe to the Austrian story that banks intervening in the market by flooding it with cheap credit that's not really backed up by genuine saving and pushing interest rates below what they should be, if that causes problems, then that. So when you're asking me what factor, so since all those rounds of QE, because of that framework and that history I just summarized for you, I was very alarmed that the Fed was just blowing up giant asset bubbles, just like the housing market was blown up clearly to unsustainable levels. Likewise, another thing too is if you just chart the S&P 500 index against the size of the Fed's balance sheet, their total assets, obviously with one on one axis and one on the other. It's like hand in glove from the start of 2009 up and through 2016. It's when Trump gets elected, all of a sudden the market starts shooting up, even though the Fed's balance sheet was hovering, was just staying pat. So, so it's not just ideology leading me to say that it looked like the rounds of QE were what was driving the U.S. stock market. They match pretty good, and even defenders of QE would admit that. So the mechanism that would be different. They would say, yeah, the rounds of QE were good for fixing the economy, and then investors saw the Fed was taking action, so bid up stock prices because now that changed their expectations. So both the critics and the defenders of the Fed agree that QE was driving stock prices. It's just, like I say, the defenders would say it reflected fundamentals because the Fed changed fundamentals by doing this great policy of QE.
So, Bob, I'm going to check out that article. So you're saying in 2007, you wrote an article predicting recession was happening.
Right. I said that the Fed had set us up for a recession and that it was going to be of the same level as the one in the early 80s. Basically.
Okay. So I'm kind of hearing you're saying something similar now.
I'm saying I think it's going to be a lot worse. Just because, in terms of cause and effect, the magnitude of the disturbance and how big, the ensuing recession, it's what they've done since 2008 dwarfs anything in history that they've done. And so to the extent that the distortion has something to do with the size of the necessary correction. So let me also just make sure I have my bases covered here. If it starts to collapse and then they go ahead and do QE 4 and 5, that might kick the can down the road some more. So again, it's not obvious when they're going to let the thing fully hit. But I am saying in terms of the distortions they set up and the kind of correction that would be necessary, that what they've done since 2008 dwarfs what they did in the mid 2000s. So to the extent that we think at all, some of the housing bubble was attributable to the Fed's policies, and that's partly what set up the financial crisis. I think we have a similar thing. And just look at what the stuff that's going on in the repo markets. I don't want to go too far afield here from what you want to discuss, but last September when the repo crisis first hit and the Fed came in, there were articles on CNBC where they're just poo-poo. Oh yeah, some firms have tax payments due. There's nothing to see here. And then now they're talking about a permanent repo facility, and they're pumping $450 billion on net or something like that since then. So I'm just saying, there's all these pockets of things, these crises that are going to keep flaring up, and the Fed can keep whacking them down. But at some point, I think they're going to have to decide: are we going to just print money every time there's a problem? And once the world thinks that's what they're doing, then I think the dollar falls significantly in value. So part of what happened with I think the rounds of QE and why it didn't lead to a massive drop in the value of the dollar is that investors around the world believed Bernanke when he said, oh, no, don't worry, this is a temporary thing. We'll unwind these programs as soon as the economy recovers. And now they're seeing that, oh, wait a minute, we started trying to unwind it. Oh, and that sucked reserves out of the system and led to the repo crisis. So now they can't really. So I think as more time passes, it's going to be clear that the Fed can't remove all this, quote, extraordinary accommodation. And then they're going to have to decide, what do we do? Do we just let everything crash? Or do we just keep pumping in money and see what happens to the dollar?
One thing that I learned a lot from your talk, as I always do at Think Tank. One thing you said actually scared me. Like I would tell you, we've been expecting a recession, and we know what the government is doing in these boom and bust cycles. The thing that you shared with me that was concerning was you had shared how when the recession officially started, I mean, they don't announce the recession officially started till months after it actually happened. And you had shared that you looked at the notes when the Fed met during the month the recession officially started, and everybody thought everything was fine except for one person. And this is supposed to be the wisdom, or these people are the ones supposed to being able to see these recessions and see where the economy is going. Would you mind explaining that better than I just did, Bob?
Sure. So, I mean, everything you said was fine, but yeah, just to make sure that your listeners get it. So when there's this thing called the NBER, the National Bureau of Economic Research. And so when we talk about historically, like, oh, when was the last recession? What were the start and end dates? So this is the group that gives you the ostensibly official, and they do it by month, right? So what we think of now as the Great Recession technically started in December of 2007, even though, remember, the financial crisis wasn't until September of 2008. So the U.S. economy had actually been in recession for several months up to that point. But what I was saying is this is always like a looking back technique, that it's only after the Fed, because there's data lags and stuff like that. The numbers that people use to assess whether the U.S. was in recession or not, there's lags in terms of getting all the final numbers for those things. So it's really only months in the future that, looking back, they can confidently say when they think the recession started. So what I was saying in the story I told the think tank was, remember, so Ben Bernanke was the Fed chair when the Great Recession happened. But on the Federal Open Market Committee was Janet Yellen at the time, and then she was, nominated by Barack Obama to replace Bernanke. And so, during her confirmation here, I don't know if it was during the hearings or just when her name was being bandied about, her defenders were saying, oh, Janet Yellen's good because back when everybody else had their head in the sand, she knew that there was problems. And what they point to is the minutes of the Fed meeting when it met in December. So this is now, looking back in hindsight, the month that the official people say the recession officially began. And so when you look at the meeting, the minutes of the meeting when the Fed officials were talking about what should we do with interest rates, blah, 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 in December of 2007, Janet Yellen was just concerned about the future. She was saying, yeah, whereas everyone else was pretty optimistic. So it wasn't that Yellen said, you know what, I think we're in a recession right now. It was just she thought a recession was coming. So my joke, you might remember, Andy, I said, not only did Yellen fail to predict the recession, she didn't even post-dict it. In other words, when they were meeting, the recession already was underway, and we're congratulating her for knowing a recession might be in the cards, even though it had already started. It's just compared to all of her peers, she was so much better than them that she's to be congratulated. So that was the anecdote, that the Fed officials meeting when the recession, what would be considered the biggest recession since the Great Depression, was already started, that most of them didn't even think there was any trouble brewing, whereas she had the foresight to know, I think actually we're in trouble. And, and by the way, it's not like she said this is going to be the worst thing since the Great Depression. It was just she was not as confident about the future as everybody else on the committee was.
So I don't know if this is too broad of a question. So on this committee, right, and why is there a lack of representation of Austrian school of thought?
Well, if you asked a mainstream person or somebody involved with the Fed, they would say because the Austrians are a fringe group. they're not scientific. They have their own journals and stuff. They were big, they had their day back then. Mises had his critique of socialism, and Hayek did some good stuff, but anything important the Austrians did has been absorbed into the mainstream, and the rest of this is, they're kind of, cranky guys who are anti-government, they're ideologues. So that would be the official reason that there's not good scientists. The Austrian view would be because, it's sort of like, why wouldn't Castro hire a bunch of free market economists to help him plan the economy? Because that wouldn't really work, right? So if the Austrians think the Fed, shouldn't exist and is causing the business cycle, you're probably not going to end up working for them. And then even if you could say, a more moderate thing, like, well, okay, sure, you're not going to be able to abolish it, but still, couldn't you get some people on there with some sensible views? Again, it's tricky institutionally for someone to advance in an organization where they're totally at odds with the prevailing, paradigm.
One thing we always like to ask our guests towards the end of the podcast is if they could recommend a book. Like, let's say somebody, this economics sounds interesting. I don't want to get too deep in the details, but is there something that could give me a good overall view of economics, maybe in particular the Austrian viewpoint?
Okay, sure. So if you just want a pretty good introduction just to standard economic, like free market thinking from an Austrian perspective, then Henry Hazlitt's book Economics in One Lesson is really good. I think that's it's a classic. I think he wrote in the 40s maybe, but it's still really good, at least for an adult. Like he refers to some things that like a teenager or something might not identify with, but for an adult reader, that's a good introduction. If you want something really specific on the Austrian school itself, though, with the risk of immodesty, I would suggest my own book choice. That what they asked me to do is to take Mises' Human Action, which is an intimidating 900-page book with a lot of big words and stuff, and they said Mises has a very Germanic writing style, and they said boil it down to like 300 some pages that an undergrad could get. And so that's what I did in my book choice, is to take the essence, the major contributions of Mises, and to put it in one book that is accessible to an undergrad reader. So that gives like the full explanation of the Austrian business cycle and that sort of thing.
What sort of things would our listeners expect if they were to listen to your podcast, the Bob Murphy Show?
Well, so that way it's kind of eclectic, but I alternate between doing my like solo episodes where I just talk about topics, and then every other episode is an interview. So it's billed as the podcast for free markets, free minds, and grateful souls. Meaning, I'm an economist who's interested in free market economics, but also, I'm more interested in getting people to think through, to be logically consistent. And hey, if you've got this worldview, it's got a glaring contradiction. I just try to point that out. And I'm also a Christian, so I bring in, spiritual things too.
Well, tell us a little bit about the other podcasts that you and Lara do together.
Yeah, so that's the Lara-Murphy Show. So that's LARA -Murphy Show. So it's Carlos is the one he's a businessman in Nashville. When I lived there, he introduced himself to me. He had been, believe it or not, working on a PowerPoint to show commercial bankers how fractional reserve banking works. And he was going around to meetings of commercial bankers and just giving them a presentation and showing them what they do and how they cause business cycles. And they would come up afterwards and shake his hand and say, wow, I had no idea we were doing that. Thanks. So I was when I heard he was doing that, I thought it was crazy. And so in him preparing his PowerPoint, he came across my study guide to a book that Murray Rothbard had written. And so Carlos was using my study guide just to make sure, the economics was right in his presentation. And then he saw that I happened to live in Nashville. So I've moved since, but at the time I was there. So he introduced me to Nelson's stuff. He gave me Nelson's book and said he was into it. And so ultimately, Carlos was also a fan of the Austrian school. And he pointed out to me that, look, you Austrian economists are going around warning people about the dangers of QE and how the Fed causes business cycles, but you don't really have a solution except, the real long term. We got to educate enough people, and finally, if public opinion turns, they can change legislation or everybody said. But Nelson Nash, in the meantime, with IBC, has this idea, and notice how each household or business owner that does IBC, you're not contributing to the inflation problem. Remember what I told you guys 10 minutes ago about if you do a policy loan, then you're not causing inflation the way taking a commercial bank loan does. And so he was saying the more people we get to do IBC, it's like Austrian economics being implemented in action, and it's moving towards the solution one household at a time instead of having to wait to educate enough people to then do something. And so that's what made me I was wow, that's great. So it sort of married Austrian economics and IBC. So we wrote a book together and then launched this podcast, the Lara-Murphy Show. So it's largely talking about financial topics from the perspective of Austrian economics and Nelson Nash's IBC. So that's kind of the context or the framework for our discussions there.
Great. Now, actually, this question just came to mind. We've kind of had a little joke that the more initials after your name, the harder it is to understand infinite banking concept. And you actually have a PhD in economics. How did you get over? A lot of times people have that arrival syndrome that Nelson had talked about, and here you are a PhD. How were you able to be open to it and reconcile some of the facts that IBC can do?
It took some time, and so my joke was, and I would say this in front of Nelson, so he thought it was funny. Is I would when Carlos first gave me Nelson's book, and I read it, and my first thought was, oh, this is a great guy. He's got a lot of homey wisdom or something, or folksy wisdom, and you want to have a beer with him. Great guy. He's got a lot of wisdom, but come on, there's 5 things wrong with this. And then I stuck with it though because I respected Carlos and he didn't seem like an idiot. And so I thought, okay, there's got to be something more here. Let me not just dismiss this. And then I learned more. Part of my problem was I didn't really know how a whole life policy worked. I really just knew about term insurance, like theoretically. I didn't understand the principles of permanent life insurance. And so all of Nelson's illustrations were kind of like a black box to me. And and then just the more I learned about how whole life worked and things, and then it went to an IBC think tank and saw some presentation, it was like, oh, okay, I misunderstood that one thing. So there's 4 things wrong with this book. And then I'd learn more and be like, oh, actually that one thing, now I see what Nelson meant. Okay, but still there's 3 just terrible fundamental flaws with IBC that just kept melting away. Then finally, after the last one melted away, I was like, geez, how come everyone's not doing this? What a bunch of idiots. And so So that's kind of what happened with me. So I will be honest, if Nelson had just mailed me his book or something, it wouldn't have done anything. I would have looked at it, said this is cranky, and put it on my shelf, and I would have forgot about it. So it was really just the historical accident that Carlos was the one who introduced me, and I could tell he was a serious thinker, and so that if he took this seriously, I didn't want to just dismiss it. And so that's what happened. A lot of it was, like I said, so the main problem was I just didn't know how a whole life policy worked. And so a lot of what Nelson's, and then also there are places where Nelson, he would say something like, this isn't about interest rates. So I thought what Nelson meant was, oh yeah, the critics are right. The rate of return's terrible on this. So I just thought that was his way of putting lipstick on a pig. Now I understand more what he meant. So yes, if you do IBC, you will end up with in the future more wealth than if you don't. And so in that sense, you increase your rate of return necessarily if you end up with more, but his point being, if you're trying to analyze rates of return you're missing what he's saying. And so now I get why he would try to just put the kibosh on that to say, if you're trying to look at rates of return, I know you're going to miss what I'm saying. He wasn't thereby admitting, oh yeah, this is a terrible place to put your money.
Bob, what would you say if somebody is on the fence about IBC? Maybe it sounds good, but I don't know. I'm on the fence. What advice would you give them?
I would say they should look at or listen to on the Lara-Murphy Show. There's a point, I don't have the numbers handy here, but some of the episodes, Carlos and I just go through and walk through our book, The Case for IBC, that we co-authored with Nelson. And we kind of just do the highlights of each chapter. So it's spread out over however many chapters there are in that book. I forget now. So I would say just listen to those. And in particular, there's one where I focus on some of the objections and try to answer them. And so because I think that's what happens, like things like, gee, isn't it a no-brainer to do buy term and invest the difference? That's what Dave Ramsey. And when you walk through and show, I can go through and show why that's a wrong, that's apples to oranges, and then you can just see how complicated the whole thing is, and you realize that, a lot of this glib wisdom coming from the gurus, it's clear they really don't know what they're talking about. So it doesn't mean that they're wrong and that whole life is a great thing and that IBC works, of course, but it just does serve to show these people who are confidently telling you that IBC is dumb. They don't, either they're lying or what I think is they really don't understand what they're talking about, and they believe what they're saying and they're just wrong. So that's what I would say, that somebody who's on the fence, if you're on the fence, it probably means you're intrigued by it and you're thinking maybe there's something there, but then you have these doubts that are like holding you back. Like, wait a minute, this can't be right because, blah, blah, blah. And I'm saying, if you listen to Carlson and me go through the contents of that book on our podcast, I mean, you can get the book too, but then you have to pay for it. I'm saying this is a no commitment thing except your time. To just listen to us explain some of the, the main takeaways from each chapter. I think you'll realize. I mean, another quick one, Carlos goes through the history of how the tax laws were changed to deal with whole life. And part of the story was after the 86 Tax Reform Act, because the stock market crashed in 87, the real estate market tanked because of the removing of the exemptions and whatnot, that what are rich people supposed to do? And a lot of them started going into single premium whole life policies. And that's what ultimately led Congress to change the tax laws and with what we now call the MEC rule or whatever. So regardless of all that stuff, it's kind of funny. Gee, if it's such a stupid place to put your money, isn't it weird that Congress had to change the tax laws to stop so many rich people from doing this so aggressively? Like, can it really be that dumb if Congress had to change the rules to stop all these rich people from doing it so much? That stuff like that.
Awesome, Bob. Thanks so much. Really appreciate your time and your insight that you shared with us. Thank you.
Thanks for having me, guys.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.